Fortunately, we haven't been materially affected. We've been working from home instead of working in our office in New York City, but otherwise things are running very smoothly. We've certainly had a lot more calls with clients with all the market volatility, and we've had a lot more calls with our companies that we own, but we're very fortunate in that it's business as usual, just business from home instead of business from the office. We believe our approach to investing is timeless, and so we haven't made any changes because of the COVID pandemic. Equity markets are emotional, and sometimes they get too euphoric and push prices too high, and sometimes they get too panicked and push prices too low. Now, the COVID pandemic has certainly created some new investment opportunities where we've been able to take advantage of where we think the market has panicked too much and where that perception is out of sync with the reality. The companies in our portfolio have shown their resilience. In fact, their earnings have been slightly less impacted than that of the overall market. In spite of their earnings being less impacted, though, many of the stocks, because of the panic sell-off, have seen their stock prices go down more than the rest of the market, and that's created a great opportunity. And since things have bottomed back in March, we've seen what's been one of the best 6-month performance periods in the history of our firm. And despite having one of the best 6-month periods in our firm history, the valuation of our portfolio today is still one of the most attractive it's ever been. We actually haven't sold any stocks directly because of the crisis, although we've sold some stocks indirectly because of the crisis. Let me explain. This year, we've sold our holdings in Microchip, a semiconductor manufacturer, and Centene, a healthcare company, not because they were impacted by COVID, but actually because of the opposite. They held up really well. Their stock prices held up really well as the rest of the market was selling off. And the reason why we sold those is because we used their strong stock prices to get proceeds so we can invest in other stocks that we think the market sold off too much and add more value to the portfolio. The selling related to the COVID pandemic was indiscriminate in our eyes, and we saw several opportunities where we can buy companies that weren't going to be that hurt by the pandemic and yet saw their stock prices decline remarkably. 2 examples of that we've added to the portfolio this year is Dell, which makes laptops and computer infrastructure equipment, and XPO Logistics, which provides a lot of the logistics for online shopping and the online economy. Both those stocks saw their stock prices fall more than 40% in the initial weeks of the panic. And yet today they're actually up on the year. And that panic gave us an opportunity to buy these 2 great businesses at very discounted prices. It's really hard to figure out what's going to happen for the rest of the year, and we don't have an official outlook about what's going to happen. What we do in our process is every day we screen the stock market for opportunities where we can buy companies at big discounts to what they're really worth. And most days when we screen through the market, we don't find anything new. But occasionally, we do find some new opportunities. And when they come up, we roll up our sleeves, we dig in, we do our research. And if the company pans out, it becomes a candidate to be added to the portfolio. So things are very volatile today. It's very difficult to tell what's going to happen next. Everything that's happened is really unprecedented. But we don't need a crystal ball to execute our process. We just keep shopping through the market and finding new opportunities as they come up. We really like our whole portfolio. It's so difficult to just pick 2 favorites. It's a bit like trying to pick your 2 favorite kids. Now, that said, let me give you 2 great examples of holdings in the portfolio. One of them is a company called Q-Rate. and they're the parent company for QVC, the cable shopping channel. And they've had some nice benefits from the COVID pandemic shutdowns. As people have been home, they're watching QVC more often, and that's allowed them to grow their customer base faster than they have in many years. Another great opportunity we see in the portfolio is Lincoln National. Lincoln is a life insurance company and annuity sales company, and they're not really significantly impacted by the virus. And yet, because they're in the financial services sector, they've been sold off almost as badly as if they were a bank with big credit losses. But it's a very simple, steady business. And because of that sell-off, it represents some of the biggest upside of any stock we own in the portfolio. If there were any stocks we had any real serious concerns about, we'd just sell them from the portfolio. So we don't have any major concerns in the portfolio. But as I look at the stocks we own, I'd say the one that we probably have the most concern about relative to the others is EOG Resources, which is an oil producer. The oil markets have been hit really hard by the pandemic shutdown, which has really cut the amount of economic activity around the world and seen an unprecedented decline in the price of oil. That said, we see oil prices recovering already as the world begins to reopen, and EOG is in a great place of strength to survive this difficult period. They have a healthy balance sheet, they have low costs, and they're some of the best operators we've ever watched.